In the previous lesson, we went over the details of the loan products. Well, here let's talk about some case studies using those actual loan products in action with real deals. This is a bread and butter single family residential flip deal. The purchase price is 100,000, rehab costs are 40,000. The after repaired value is 205. Therefore, the purchase loan, the part of the purchase price that we're going to loan the borrower, is $87,500 or 85% LTV. Final loan amount is 127,500. The way these loans work, the lender will always seek to lend 100% of the rehab. The only question becomes how much of the purchase price are they going to cover? Are they going to ask the borrower to put down 10, 15, 20%, or 25% of that purchase price? So that's the only question in the deal from an underwriting perspective. And what decides where in that spectrum they fall as far as their out-of-pocket down payment? In this case, their cash down was only 12,500 plus their closing costs. Well, how much experience do they have? Where's the property? What's their credit? All of those things will factor in. What's the size of the rehab budget relative to the total loan amount? The bigger the rehab budget, and if the rehab budget exceeds the purchase price, and it's a lopsided deal, that will also factor into how much you'll have to put down. This is a tiny deal compared to the national average, which is $280,000. So this, a broker on this deal is making 38.25. But again, this is a small deal. But how do you build up your firm? You build up your firm by doing deals. Number one, at the very, very, very beginning, the most important thing you need to build up is a track record of successful closings. So, by any means necessary, you need to get a track record of people that can say, yes, I closed a deal with him or her, and they know what they're doing. So, that'll help you with your Google reviews. That'll help you with your reputation in the local marketplace. So, you want to get as many deals as you can get done, especially in the first 3 years, because again, you're trying to build up a track record. Secondly, when you have borrowers who they're doing $10 million deals, how do you get those relationships? You don't get them when they're at the $10 million mark. You get them when they were starting out and they only needed a couple 100,000, but you built a relationship. You educated them on the market. You educated them on how commercial financing works so that by the time they grew and they went from three flip deals in their first year to now they've got 10 deals. Now they're cashing out to buy their first multifamily to now they're refining a 200 unit multifamily. You built a body of work with them. And at that point, you're locked in. So, and most multifamily investors start out as single family investors. So, this is, again, part of building your practice. In the previous case study, that was a straight fix and flip deal. This one, we're talking about a combination of a straight purchase bridge loan along with long term financing. So, in this scenario, it was a multifamily. The value was 500. The NOI was 53. So, it was a profitable deal. My client got under contract for 405. Now, how did he get that much of a discount? Well, in actuality, he had proposed buying it for 400. They turned him down. They took another offer that was list price at 500, but they didn't close. And my borrower stayed in touch with the listing agent, and so he knew when they were supposed to close. And he called him and says, "Hey, I saw you guys were going to close. On Monday. How'd it go?" And in actuality, they walked away. He's like, "What?" "Yeah, man, the deal blew up like Sunday night. They told us they're not doing it. The day before, they walked away from the deal." And the sellers are pissed. You gonna put your offer back in? The guy's like, "Yeah." He goes, "But this time, I tell you what, offer on 405 and see if they take it." They countered with, "Okay, if we're gonna sell it that cheap, you got to go fast. So we want to close by the end of the year. We're trying to get out of Michigan and go to Florida with our grandkids. So what can you do?" He was like, "Fine, I'll do it in 3 weeks." Malcolm, we close in 3 weeks, right? Yeah. Yeah. I'll close in 3 weeks. So you did it under the contract for 3 week closing. We got it done. We did a bridge loan with a $300 balance, $300,000 loan balance. He basically put 100 grand down. The terms were 2 year interest only, 11% interest. Now, in actuality, nobody cared because he was turning that property around. This was a property that was fully stabilized, needed no work, was in perfect condition. The only reason that he used a bridge loan was because of speed. There was no way traditional financing was going to close that thing in 3 weeks. So we just did appraisal, title, credit, closed. We refinanced 3 months later using traditional long term financing. He got a 6% interest rate with a $375,000 mortgage balance, meaning he not only paid off the first loan, but he also recouped some of the cash outlay that he used in transaction costs. So for me, it was two loans within a 4 month time frame, $18,000 between both. Here's the most important thing though. We closed on time. We did what we said we were going to do. And this borrower became a long term client. Him and I have done 5, 6 more deals since then. Also, the listing agent referenced me back on other deals because they saw that I closed. And so I cannot overstate the importance of certainty of execution when it comes to other professionals and your reputation. Let's talk about the next deal. Now, this case study involves a fix and flip loan and long term financing. This was a 26 unit multifamily property. As is value was 1.6. The ARV was 2.5, and it involved me doing a $810,000 cash out refi. The borrower owned the property free and clear, so they wanted 200 grand in their pocket, and the other 600,000 was going to get their value to go up from 1.6 to 2.5. The net operating income was 190. After the rehab, it was going to go up to 337, and the refi at 70% of that ARV was 1.75, which would have netted them another cash out of 940 on the back end. So we had some special challenges with this deal because it was a first time multifamily deal for the borrower. They owned this property previously, but they never did a commercial loan before. So commercial lending was new to them. We ended up doing a non-recourse loan, which means it was in the name of their LLC with no personal guarantee at all required. And we did that with both, with the bridge and the permanent financing. So between the two loans, we had total compensation of $33,500. We owned 2 points on the loan, the bridge, and we had 1 point on the Freddie Mac refi on the back end. So I bring this up to point out that once again, when you provide value and you come through, when there's subsequent loans that need to get done, they will return to you. And the beauty of a bridge loan is short term. So any bridge loan you do this year is going to have to get redone next year. It's the math. It's a beautiful thing. So one of the advantages of coming to the commercial space is you get to build up a body of work with your borrowers, your investors, who ideally you want to have like a stable of thoroughbreds. They just want to run. And as much as you can feed them money, they're going to keep running every race. So build up your practice with bridge, with fix and flips. You'll be well served as well when it comes to the long term cash flow, stability, and value of your firm. The three big takeaways from this lesson are the best starter loans for a CMB are bridge, fix and flip, and long term DSCR financing. Two, this mix will create more consistent cash flow for your brokerage business. And then lastly, bridge loans specifically create secondary refinance opportunities that reduce marketing costs and business risk while conversely increasing your profits. Join us in Mortgage Broker Mastery. Learn from the best in the industry. Together, we'll help you achieve your financial goals and make a real impact in the world of commercial lending.